Third quarter of 2018 will be remembered as a great one for stocks. The Dow Industrials, Nasdaq Composite, and S&P 500 all rose more than 7% in 3 months, as bullish investors maintained their confidence in the face of some momentous news developments. Consistently strong economic indicators and impressive corporate profits helped motivate the summer rally. While the prospect of a global trade war did not ruffle Wall Street, investors in other regions shouldered more worry about the imposition of tariffs. Meanwhile, the Federal Reserve continued raising interest rates, the housing market cooled, and wage growth improved. The trade war with China that began in the second quarter intensified in the third. In early July, the U.S. and China each began imposing import taxes on each other's products. They began with taxes on $34 billion worth of goods, which was then increased to $50 billion in late August. In late September, the U.S. placed a 10% tariff on $200 billion more of Chinese imports, slated to rise to 25% in 2019. China retaliated with further tariffs on its end, assessing levies on $60 billion worth of American-made products reaching its borders. Apart from a trade war, there was also a crucial trade deal at the end of the quarter. On September 30th, the U.S., Canada, and Mexico agreed to a trilateral update for the North American Free Trade Agreement, or NAFTA. The Federal Reserve decided on another quarter-point interest rate hike, taking the federal funds rate to a target range of 2 to 2.25%. This was the central bank's third rate move of 2018, and one more is widely expected in December. The Fed now projects 3.1% growth for the economy in 2019, as opposed to the prior forecast of 2.8%. The July and August employment reports from the Department of Labor were fair to good. July saw employers add a mediocre 147,000 net new jobs, but that improved to 201,000 the next month. More importantly, the annual rise in worker wages improved to 2.9% in August from 2.7% in July, approaching the level economists have long wanted to see in this recovery. In both months, the headline unemployment rate was just 3.9%. The underemployment, or U6 rate, ticked down to 7.4% in August from 7.5%. Existing home sales, which make up the vast majority of residential real estate transactions, declined 0.7% in July and went flat in August. The average interest rate on a fixed 30-year home loan went from 4.55% at the end of June to 4.7% 3 months later. Commodities had a rough third quarter, with crude oil and gasoline notching gains, but most others, including gold, silver, copper, and a number of soft commodities, posting losses. The U.S. dollar index was flat for the quarter, but annualized inflation lessened. The Consumer Price Index displayed a yearly increase of 2.9% in July, dropping to 2.7% in August. Yearly core inflation went from 2.4 to 2.2%. The third quarter definitely flipped the usual Wall Street script, in which bulls take the summer off between spring and fall rallies. There was no such behavior in 2018. The three major indices rose as much in the third quarter as some analysts thought they would all year. The Nikkei 225 was the one major foreign index that performed as well as its American counterparts during the quarter. The broader MSCI World Index also had a fine third quarter, rising 4.5%, while emerging market stocks fell by 2%. The Russell 2000 Small Cap Stock Index advanced 3.25% in the third quarter. Also, the current bull market became the longest in the annals of Wall Street, driving stocks to new record heights. The third quarter was not only remarkably rewarding for investors, but also remarkably tranquil. During the quarter's last 70 trading sessions, the S&P 500 did not make a single 1% move. That kind of calm may be rare in the fourth quarter, which quickly presents investors with both the fall earnings season, Hurricane Michael, and a midterm election. Wall Street is nothing if not unpredictable, of course, and some legendary market falls have happened early in fourth quarters. But currently there is much to be optimistic about. Economic indicators are still solid for the most part, the latest GDP reading has been impressive, and wages are keeping pace with inflation. And that optimism may persist through the end of the year. As always, we appreciate your trust and the opportunity to help you navigate the financial waters of life. If you have any questions, please contact your Life Plan Relationship Manager, and have a great day.